Imagine stepping up to the podium for your quarterly earnings presentation.
Right, the big moment.
Exactly. You are the management team, and you are just ready to deliver this phenomenal narrative. I mean, you just beat Wall Street's profit expectations by a massive 43%.
Which is huge.
It is. You grew your total volume by double digits. You expanded your profit margins during this, really volatile commodity cycle. So you deliver this news expecting a standing ovation from the market.
And they didn't get one.
No, not at all. Instead of applause, you just watch in real time as institutional investors rush for the exits. They instantly wipe over 8% off your company's value overnight.
Yeah, it's a brutal reaction.
Welcome to today's transcript coverage. We are jumping into a deep dive on Mission Produce, ticker symbol AVO, and we're breaking down their fiscal first quarter 2026 results.
It's honestly a fascinating case study in market psychology versus operational reality.
Yeah, completely.
Because you have this massive divergence. On the call, management is projecting absolute confidence. I mean, they're calling it an incredibly strong start to the year.
Right.
Yet the tape just tells a completely different story.
The tape was brutal. So just to set the scene for you, the investor listening to this, before this after-hours call, AVO was trading at $13.23.
Okay.
The next morning, the opening bell rings, and the bottom just falls out. It closed that next day at $12.15.
Wow.
Yeah, that is an 8.16% drop. And this was not, a quiet, low liquidity slide.
Yeah.
Volume absolutely spiked.
People were rushing for the door.
Exactly. We saw 2 million shares change hands.
Yeah.
To put that into perspective, their average daily trading volume is roughly 810,000 shares.
So more than triple.
More than triple the normal trading volume hitting the sell button in a single session.
And look, when you see that kind of aggressive, high-volume selling immediately following what looks like a top-line and bottom-line beat, it means the market is looking past the current quarter.
Right. They see something coming.
Exactly. Institutional capital doesn't care about the victory lap you're taking today if they see a cliff rapidly approaching tomorrow.
And that is our exact mission for today's deep dive. We need to unpack this disconnect.
Yeah, figure out the why.
Right, like why is a quarter with an earnings beat and a 14% increase in avocado volume being rewarded with an 8% haircut?
It doesn't make sense on the surface.
It doesn't. What is the street seeing in the forward guidance that management is, trying to smooth over with their optimistic tone?
Because if you're a seasoned investor trying to underwrite this company right now, you are looking at a business in the middle of a massive structural transition.
Totally. You're trying to gauge the integration risk of this huge pending acquisition, the leverage risk of the debt they're taking on, and just the fundamental health of their core farming operations.
You need to know if this $12.15 price tag is a transitional discount.
Like a temporary dip you should buy into.
Right, exactly. Or if it's a value trap that's just going to keep burning capital.
So let's start by laying out the headline numbers to get our baseline, and then I want to really tear into what these figures are actually hiding.
Let's get the raw data on the table first.
All right, so here's the snapshot. GAAP earnings per share, the standard accounting metric, came in at a loss of 1 cent.
Which doesn't sound great.
No.
Yeah.
Especially compared to a positive profit of 5 cents a year ago. But then when you look at adjusted EPS, which strips out those one-time non-recurring costs, it was positive 10 cents.
And the street consensus was sitting at what, 7 cents?
7 cents, exactly. So on an adjusted basis, they beat bottom line expectations by roughly 43%.
That's a massive beat.
It is. But then you look at the top line. Revenue was $278.6 million. That represents a very sharp 17% year-over-year decline.
Right, 17% down.
But yet again, adjusted EBITDA, which is essentially the cash profit generated from core operations before the accountants and the tax man get involved, that came in at $18.5 million.
Which is actually up 5% year over year.
Exactly. And as we mentioned, total avocado volume was up 14%.
So let's pause right here because these numbers just sound completely contradictory to anyone who usually analyzes traditional software or consumer retail companies.
Totally. Top-line revenue is shrinking aggressively by 17%.
But the bottom line cash profit is actually growing. And the sheer volume of product being moved is up 14%.
Yeah, my immediate instinct when I see a gap loss but a massive adjusted EPS beat is that management is hiding a lot of operational sins in that adjustment category.
Oh, absolutely.
Like, what is dragging down that gap number?
Well, the first place you always have to look when you see a divergence of that magnitude between GAAP and adjusted earnings is the SG&A line.
The selling, general, and administrative expenses.
Exactly, the corporate overhead. It's usually where the noise lives. And in this specific quarter, Mission's SG&A jumped by 31%.
Wow.
Yeah, that's a $6.9 million increase year over year.
A 31% jump in overhead while your total revenue falls 17% is, usually the ultimate red flag.
It's terrifying on paper.
It sounds like a company completely losing control of its cost structure. Like maybe they're getting eaten alive by wage inflation or ballooning corporate headcount.
It certainly looks that way at first glance. But if you dig into the mechanics of that adjustment, you see that this increase was almost entirely driven by a single specific line item.
Which was?
$7 million in transaction advisory costs. These are the external costs associated with their pending acquisition of Calavo Growers.
Wait, $7 million just in advisory fees for a single quarter?
Just for one quarter, yeah.
Let's break down what that actually pays for.
Yeah.
Because to a retail investor, that sounds exorbitant. What goes into $7 million of transaction friction?
It is the cost of executing large-scale public market M&A. When you agree to acquire a massive competitor like Calavo for nearly $500 million, you are mobilizing an army of external specialists.
Right. The bankers and lawyers.
Exactly. You are paying premier investment banks for valuation opinions and debt structuring. You're paying elite corporate law firms to draft the merger agreements, handle the antitrust filings with the FTC.
And review, hundreds of commercial contracts?
Thousands, probably. Plus, you have accounting firms conducting deep forensic due diligence on Calavo's historical financials.
Oh, and don't forget the environmental side.
Right. You have environmental consultants flying out to inspect Calavo's pack houses and processing facilities to ensure there are no hidden liabilities.
Like soil contamination or wastewater violations.
Exactly. All of those billable hours hit the income statement immediately. So if you back out that specific $7 million M&A line item, Mission's actual day-to-day operating SG&A was completely flat compared to the prior year.
Oh, wow. Okay, that drastically changes the narrative.
It really does.
So the cost structure of the underlying business is actually highly disciplined. They aren't bloating the corporate office.
No, not at all.
They're just paying the toll to execute a massive strategic pivot.
It shows management is holding the line on overhead, but it also perfectly highlights the central tension of this entire quarter.
Which is?
The core business is actually operating with extreme efficiency in a very difficult deflationary pricing environment. But the strategic moves they're making for the future are muddying the current financials.
And creating a lot of apprehension in the market.
Exactly.
So let's dig into that core business, because this is where the math starts to feel a bit like a funhouse mirror.
Oh, the avocado margins? Let's do it.
Yeah, let's look at their primary engine, the marketing distribution segment. Sales in this segment plummeted 21%, dropping down to $234.8 million.
And the catalyst for that drop is a massive, roughly 30% collapse in global avocado pricing.
Because the Mexican harvest this year was incredibly abundant, right?
Huge. They saw much higher yields, which meant an absolute flood of fruit hitting the market simultaneously. So the spot price per pound just cratered.
But despite sales dropping 21%, segment-adjusted EBITDA skyrocketed 33% to $12.9 million.
Yeah.
And their consolidated gross margin expanded by nearly 2 full percentage points, up to 11.3%.
It's a huge spread.
It is. And management keeps repeating this catchphrase on the call to explain this. They keep saying, we are a volume-centric business.
Right. They leaned on that hard.
They did. They're essentially telling the market to ignore the total revenue drop and just focus on the throughput. But I have to play devil's advocate here.
Please do.
It sounds a bit like a struggling, dying brick-and-mortar retailer standing there and claiming, look, we're losing top-line revenue on every single item we sell, but don't worry, we'll make it up in volume.
I can see how it sounds like that.
Right. My instinct when I see a 30% price plunge in a core commodity accompanied by a jump in profit is that they must just be squeezing the farmers on the acquisition cost.
Like they're being predatory.
Yeah, are they just buying the fruit for pennies on the dollar because Mexico overproduced?
You're hitting on the exact mechanic, but we need to reframe how we view mission produce. To understand how a 30% price drop leads to higher profit, you have to completely separate the cost of the underlying commodity from the value of the service Mission provides.
Okay, separate the fruit from the service.
Right. Mission produce is not just a farmer hoping and praying for high crop prices at the market. They are fundamentally a global logistics, ripening, and packing network.
They're essentially a toll road, not just the cars driving on it.
A toll road is a great way to visualize it, but it's a highly specialized, value-added toll road dealing with a highly perishable product. Their primary job is not just moving a box from point A to point B. They source the raw, rock-hard green fruit from Michoacan. They transport it across the border through a sophisticated cold chain logistics network.
Down to the exact degree.
Exactly. They bring it into their massive pack houses. And here's the crucial part. They utilize highly technical ripening rooms.
I was reading about this, the ethylene gas, right?
Yes. They use precise mixtures of ethylene gas, exact temperature controls, and specific humidity levels to bring that avocado to the exact stage of ripeness required by the specific retail client.
On the exact day it's scheduled for delivery.
Exactly. When a supermarket chain buys from Mission, they are not just buying an avocado, they are buying the guarantee that the avocado will be perfectly ready for a consumer to squeeze and put in their cart that weekend.
So the supermarket is paying a premium for that logistical certainty and the ripening technology, regardless of what the baseline commodity price of the fruit is.
Exactly. And what happened this quarter is that because the Mexican harvest was so massive, the raw material cost, the cost of buying the unripened avocado from the grower, plummeted.
Right. Spot prices cratered.
Now, the final retail price at the grocery store dropped, yes, but Mission's cost to acquire the raw fruit dropped even faster?
Let me make sure I'm visualizing the math correctly for the listener.
Go for it.
Let's say last year, in a tight supply market, an avocado sold to the supermarket for $2.
Okay.
It cost Mission $1.80 to buy it from the farmer, run it through the ripening room, and ship it. So they make 20 cents of gross profit.
Simple enough.
Right. But this year, the market is flooded.
Yeah.
The price to the supermarket drops massively to $1.40. Revenue looks terrible.
Yes.
But because Mexican supply is so abundant, Mission can buy that raw avocado, pack it, and ship it for only $1.10.
Exactly.
So now they are making 30 cents of gross profit on that same avocado. The top line revenue is down, but the per unit margin spread has actually widened.
That is the exact underlying unit economics of their business. They capture a wider spread. And you also have to factor in the consumer behavior side of this.
The demand side.
Right. Because the fruit is cheaper, consumer demand naturally rises. Supermarkets put avocados on the front page circulars, they run promotions, and everyday shoppers buy a bag of 5 instead of just 1.
Which is why Mission's total volume increased by 14%.
Exactly. So they are making a wider margin on a significantly higher number of units passing through their system.
Man, that's wild.
They programmed that cheap fruit incredibly effectively across their entire customer base. They used their internal data and category management tools to advise retailers on how to price and promote the fruit to move the maximum amount of volume.
So they're almost acting as consultants to the grocery stores, too.
They really are. And this is why management insists they're judged on throughput and margin discipline, not on the raw commodity price swings.
Because the 30% drop in the spot price of an avocado is entirely out of their control. Mother Nature dictated that.
Yep. But the expansion of their gross margin by nearly 2 full percentage points is entirely within their control. It's proof of operational execution within their distribution network.
That makes a lot of sense when you break it down to the unit level. So for you, the investor, you have to strip away the noise of the commodity volatility to see the underlying operating leverage.
Exactly. The headline revenue number shrinking by 17% is actually a distraction.
The real metric of health for the distribution segment is total volume multiplied by per unit margin spread.
Yes, that's the core engine.
And on that basis, the core avocado logistics business is humming beautifully. But as we established right at the start, the stock chart tells a different story.
The market wasn't buying the victory lap.
They were not. And I think part of the reason is that while avocado logistics are the core engine, they aren't the whole story. Let's look at the other side of the business. Let's look at the weak link of the quarter.
The international farming and blueberry segment.
Yeah, this is where the narrative of operational invincibility definitely gets challenged by the messy realities of agriculture.
It really does. In the blueberry segment, the financial dynamics are the exact inverse of the avocado segment.
Sales were actually up, right?
Yeah, they grew 12% to $40.8 million. Pricing was up modestly and volume was up. But unlike the avocado segment, profitability here just fell off a cliff.
Adjusted EBITDA was nearly sliced in half.
Yep. Falling from $6.2 million in the same quarter last year to just $3.3 million this quarter.
So top line is growing, but the bottom line, cash profit, is getting crushed. And management blamed this margin compression on something they called double density planting on their newer acreage.
It sounds like corporate real estate jargon.
It does. Double density planting sounds like a developer trying to cram more luxury condos into a single city block to maximize rental yield. What does this actually mean on a physical blueberry farm in Peru?
Well, the condo analogy isn't actually too far off in terms of maximizing yield per square foot, but you have to apply it to the biological lifespan of a plant.
Okay, walk me through it.
When Mission Produce establishes a brand new blueberry farm in Peru, they're sinking millions of dollars into land leases, irrigation infrastructure, and soil preparation.
Big upfront capex.
Huge. And they want to generate a cash return on that land as quickly as possible. So in the first year to year and a half of that farm's life, they utilize double density planting.
Meaning they plant the young blueberry bushes very tightly together.
Exactly. They pack them into the rows. Because the plants are young and small, they don't require as much space. And this high density allows Mission to get a reasonably large, profitable harvest off that land early in the cycle.
Okay, so it accelerates the timeline to initial cash flow.
Exactly. But it's a biological ticking clock.
Right, because they grow.
Yeah. As those blueberry bushes mature into their second and third years, their physical footprint expands. Their root systems grow deeper and wider, their leafy canopies expand outward.
And suddenly, they're aggressively competing with their neighboring plants for water, for soil nutrients, and for crucial sunlight.
They outgrow the condo.
The infrastructure just can't support that many mature residents.
Yes. If you leave them packed together, the overall health of the field deteriorates and the fruit quality drops.
So what do?
To ensure the long-term health and the maximum normalized yield of those mature plants, you have to physically send labor crews into the field to spread them out. You have to thin the herd.
You literally uproot and space out the plants.
Yep. And when you execute this process, the plants inevitably undergo a period of biological shock.
Sure, they've just been transplanted.
Right. And because you have drastically reduced the total number of physical plants per hectare to give the remaining ones room to breathe, you see a sharp temporary drop in the overall yield of blueberries per hectare of land.
And a drop in yield per hectare is devastating for margins because your fixed farming costs don't change.
They don't budge.
You're still paying the same land lease, you're still running the same expensive irrigation pumps, and you're still paying the same baseline agricultural labor to maintain the field.
Exactly.
But now, all of those fixed costs are being divided by a significantly smaller number of harvested blueberries.
That is the exact margin compression mechanic. Your per unit production cost spikes violently.
Wow.
Right now, Mission Produce has about 700 hectares of blueberries in active production in Peru. But a massive chunk of that, 25% of that total acreage, is currently trapped in this transitional low-yield maturation phase.
That's a huge drag.
It is. They're bearing 100% of the fixed costs of maintaining those fields, but they're getting a fraction of the normalized yield.
Okay, I hear the mechanical explanation of the root systems and the density, and it makes logical sense. But I have to push back here on how management framed this.
Okay, what stood out to you?
On the call, they also mentioned that their pruning decisions and the timing of the harvest were driven by, quote, weather conditions and the long-term health of the farm.
Right.
And they emphasized that they aren't going to mismanage the farm just to hit quarter-to-quarter earnings estimates.
Very noble.
Yeah, that sounds incredibly noble and responsible. But as an investor, I've been conditioned. When I hear an agricultural company cite unfavorable weather and pruning timing to explain a 50% drop in profit.
Your skeptical alarm bells start ringing loudly.
Exactly. Is this a management team making convenient, unprovable excuses for a poorly executed crop cycle? Or is this just the unavoidable, messy reality of agricultural capital expenditures?
It's a totally valid skepticism, and honestly, it's the primary reason why vertically integrated agricultural businesses historically trade at significantly lower valuation multiples than software or asset-light consumer companies.
Because you cannot negotiate with the weather.
Exactly, and you cannot rush biology to meet a quarterly earnings deadline. The reality of this specific quarter is likely a blend of both structural CapEx realities and unpredictable weather.
So they knew the margin compression was coming on the double density hectares.
Yes. The double density transition is a known structural reality. It's modeled into their long-term CapEx cycle. That part is predictable.
But the weather part isn't.
Right. The exact week-to-week timing of the pruning process, which ultimately dictates when the plants will flower and when the next harvest will peak, is highly dependent on ambient temperatures and rainfall.
Oh, I see.
Management noted that last year, the weather allowed them to let the blueberry season run a bit longer into the quarter. This year, the temperatures dictated that they end the season at a more normalized, earlier time.
Which shifted a chunk of volume out of the quarter.
Exactly.
It is the ultimate variable cost Mother Nature deciding your revenue recognition schedule.
It is. But there is a crucial silver lining hidden in this segment that provides important context on why they tolerate this volatility.
Which is?
The blueberry maturation cycle is relatively fast. It only takes about 1 to 2 years for those newly spaced out bushes to recover from the shock and reach their full, mature productivity.
Oh, so this severe margin drag is temporary.
Very temporary. If you compare that to their core product, avocados, the CapEx cycle is brutally long.
How long?
When you plant a new avocado orchard, it can take up to 4 years of intensive capital investment watering, fertilizing, pruning, before a single tree produces enough fruit to even hit break even on its maintenance costs.
That's a massive distinction for cash flow modeling. The timeline to normalize profitability on this struggling Peruvian blueberry acreage is 12 to 18 months, not half a decade.
Right. And while the physical farming side of the blueberry operation saw its EBITDA cut in half, the broader international farming segment, which includes the physical packhouses and logistics hubs down in Peru, actually saw its EBITDA rise 28% to $2.3 million.
Wait, hold on.
Yeah.
If the farms are physically yielding less fruit because of this double density transition, how does the packhouse facility attached to those farms make more money? Less fruit should mean less throughput for the facility.
It goes back to the concept of asset utilization. Historically, the fiscal first quarter is a seasonally dead period for their massive Peruvian packhouses.
Because the harvest lulls?
Exactly. The local harvest lulls and these huge, expensive, climate-controlled facilities essentially sit idle, bleeding fixed overhead costs.
Just burning cash.
Right. But management has been aggressively working to solve this utilization problem by running more third-party fruit through those facilities.
Ah, so they aren't just packing their own mission-grown blueberries anymore.
Exactly. They're opening their doors and acting as a toll road processing hub for other independent farmers in the region.
That makes perfect sense.
Furthermore, they executed a really smart marginal CapEx investment. They recently re-engineered and modified one of their pack lines in Peru to process mangoes.
Wow. That is genuinely clever.
Right.
Let's think about the mechanics of that. You have a facility fundamentally built and calibrated for tiny, delicate blueberries or hard avocados.
Very different shapes.
Very different. They make a relatively small capital investment to modify the optical sorters, change the washing solutions, and adjust the conveyor belts to handle a completely different shape and weight of fruit.
And suddenly they can generate processing revenue from an entirely different commodity cycle.
Exactly. They are strategically filling in the blank spots on the seasonal agricultural calendar.
By processing third-party fruit and new commodities like mangoes, they achieve drastically better overhead absorption year-round.
So they turned a quarter that historically operated at a loss due to idle facility costs into a quarter that generated sustainable, positive EBITDA.
Bingo.
Okay, let's summarize where we are at this point in the narrative. Because the core avocado distribution margin is widening beautifully due to the cheap Mexican fruit and the toll road model.
Yep.
The international packhouses are finding innovative ways to absorb their overhead by processing mangoes.
Also true.
The farming segment is taking a temporary hit due to biological plant transitions, but it's manageable.
It's all very manageable.
Right. Everything we have discussed so far paints a messy but ultimately positive, execution-driven story. The 43% earnings beat makes total sense.
It does.
But we still haven't answered the central mystery of this deep dive. If everything is executing this well, why did institutional capital dump 2.7 million shares the next morning and crash the stock 8%?
And that brings us to the forward guidance.
The Q2 reality check.
This is where the pristine narrative fractures. This is the exact moment on the call where the market decided the risk outweighed the reward and hit the sell button.
Let's look closely at it. Management provided their official outlook for the second quarter of fiscal 2026.
Okay.
And they explicitly guided that consolidated adjusted EBITDA will be lower than the prior year level.
They're looking investors in the eye and telling them, enjoy the Q1 beat because next quarter our profits are going to shrink.
Exactly. And if there is one thing growth-oriented institutional capital despises, it's a guided earnings contraction immediately following a beat.
Because it signals that the current success is a blip, not a trend.
But let's look at the actual macro setup for Q2, because this is where a massive contradiction flares up.
This is the crazy part.
Right. Management expects global avocado industry volumes to rise 10 to 15% year over year. And they expect pricing to remain deeply depressed, roughly 30 to 35% lower than the $2 per pound average we saw in the same quarter last year.
So wait, let's connect the dots here because the logic seems completely broken.
It does.
In Q1, we just established that a 30% price drop combined with a 14% volume increase led to a massive 33% EBITDA beat in their core distribution segment.
Right. The cheap fruit allowed them to widen the spread.
Now, in Q2, they're guiding for the exact same macroeconomic scenario, a 10 to 15% volume increase and a 30% price drop.
But suddenly this identical setup means EBITDA is going to miss prior year levels.
The entire "we are a volume-centric business" thesis is breaking down right in front of us.
Right. If high throughput and cheap raw fruit equal wider margins, why is Q2 going to be worse?
It's the most important question to ask, and it gets to the absolute core of their operational bottleneck.
Lay it out for us.
The key difference between Q1 and Q2 is not the price of the fruit, and it's not the volume of the consumer demand. The difference is the sourcing origin.
Okay, where the fruit comes from.
Exactly. Q1 is dominated almost entirely by the Mexican harvest. Q2 is historically supposed to be the transition period.
Oh, when California comes online.
Right. It's supposed to be the quarter where the California harvest ramps up, and Mission benefits from dual origin sourcing, pulling cheap fruit from Mexico and premium fruit from California simultaneously.
Okay, so what's the problem this year?
Well, right now, because the Mexican fruit is still so incredibly cheap and so hyper-abundant, the California growers are looking at the spot market and doing the math.
And they're holding back.
They're saying, we are absolutely not picking our avocados right now. If we harvest today and try to sell into this flooded market, we'll get slaughtered on the price.
Oh, wow. So the California farmers are just going on strike. They're just leaving the fruit hanging on the trees.
Essentially, yes. Avocados have a very unique biological quirk compared to other produce like berries or peaches.
You don't have to pick them the moment they ripen, right?
Exactly. You can actually use the living tree as a natural cold storage facility. The fruit will just hang there perfectly preserved for months.
So the California growers are intentionally delaying their harvest by at least a month.
Simply waiting for the massive wave of Mexican supply to clear out of the market so wholesale prices can stabilize at a higher level.
Which makes perfect economic sense if you're a California farmer trying to protect your margin. But what are the cascading consequences of that delay for Mission produce?
The consequences are severe fixed cost deleveraging.
Because of the facilities.
Yes. Mission Produce operates massive, state-of-the-art packing and ripening facilities located directly in California. Those facilities carry immense fixed overhead.
Right. The California property taxes alone.
You have to pay the exorbitant taxes, you have to pay the salaried facility managers, and you have to pay the massive electricity bills to keep the commercial refrigeration units and the ripening rooms climate controlled.
Usually in Q2, those California facilities are humming at full capacity.
Processing millions of pounds of local California fruit, and that high volume amortizes those fixed costs down to pennies per avocado.
But right now, because of the delayed harvest, those massive, expensive assets are sitting virtually idle.
It's just dead weight.
It's like running a massive hyperscale data center. You have thousands of servers installed, you're paying the lease on the building, you're paying the massive utility bill to run the HVAC cooling systems for the whole room.
But half of your servers are unplugged and not generating any compute revenue.
Exactly. Your fixed costs remain identical, but your revenue generation is cut in half.
That is the exact dynamic. In Q1, they were a brilliant volume-centric business because the Mexican volume was perfectly aligned with their active Mexican and Texan pack houses.
But in Q2,
In Q2, they're dealing with the pain of single origin sourcing. They have all the volume coming out of Mexico, but they are forced to carry the dead weight of empty facilities in California.
so their overall per unit margin gets compressed because the overhead denominator is completely out of whack.
Exactly. The lower price environment is essentially starving their California infrastructure of the volume it desperately needs to be profitable.
And when you combine that massive fixed cost deleveraging in the core avocado segment with the ongoing struggles in the blueberry segment, the picture gets ugly fast.
Very fast.
Because remember, management noted that 10 to 15% of the Peruvian blueberry harvest is actually pulling forward into Q2.
And it is that exact same low-yield, double-density transition fruit we just talked about.
Yes, you have margin compression hitting them from multiple angles simultaneously. You have higher per unit production costs on the blueberries hitting the income statement at the exact same moment your California avocado facilities are bleeding overhead.
It proves to the market that while Mission is highly effective at managing per unit margins in a steady, predictable state, they are still fundamentally vulnerable to origin shifts and harvest timing.
They cannot completely divorce their financial performance from the messy realities of agricultural supply chains.
And that completely explains the 8% drop.
Absolutely. The institutional algorithms and analysts looked at the Q2 guidance, modeled out the idle facility costs in California and the low-yield blueberry drag in Peru, and realized that the volume-centric armor has massive vulnerabilities.
Because when your multi-million-dollar physical assets sit idle, your margins erode, regardless of how cheap the underlying commodity is.
And this anxiety over operational complexity brings us to the massive $490 million elephant in the room.
The Calavo catalyst.
This is the strategic pivot that changes absolutely everything about how you value and underwrite this company going forward.
Let's get into it.
Back on January 14th, 2026, Mission Produce signed an agreement to acquire Calavo Growers in a cash and stock deal valued at roughly $490 million.
Okay.
Management stated on this earnings call that they expect the deal to officially close in fiscal Q3 2026, so it's approaching very quickly.
And the synergy story they're pitching to Wall Street to justify that price tag is pretty aggressive.
Eric.
They're publicly promising to realize at least $25 million in annualized cost synergies within 18 months of closing the deal.
And they specifically noted that those synergies are primarily going to be driven by eliminating duplicate corporate costs and optimizing overlapping operating footprints.
But let's look past the generic M&A corporate speak of synergies and talk about the actual strategic fit. Because this isn't just about buying a rival avocado distributor to get a larger market share.
No, this acquisition fundamentally changes what Mission Produce actually is as a company.
It does. This is an aggressive, offensive move to reshape their entire logistical model. It's not a defensive tuck-in. To understand why, you have to look right back at the capacity utilization issue we just discussed with the empty California pack houses. Calavo brings entirely new commodities into Mission's distribution network.
Specifically, they bring a massive volume of tomatoes and papayas.
Right.
Okay, wait. How does adding papayas solve an empty avocado pack house problem?
It solves the logistics, routing, and truck utilization problem. Mission has spent decades building this incredibly sophisticated, expensive cold chain distribution network across North America.
Right.
But fresh produce is inherently seasonal. There are inevitable troughs in the calendar where the trucks are driving cross-country half empty and the regional ripening rooms are only operating at 50% capacity.
I see.
By adding Calavo's tomatoes and papayas, which have completely different seasonal harvest peaks, different geographic origin points, and different velocity in the supermarket, you smooth out those logistical troughs.
You push significantly more total volume through the exact same fixed infrastructure.
Exactly. If a truck leaving a distribution center in Ohio is only half full of avocados, you fill the rest of the trailer with tomatoes.
You instantly lower the per unit freight and handling cost for everything on that truck, including the avocados.
It is entirely about maximizing the yield on their logistical real estate.
Okay, that makes perfect operational sense. That is the physical supply chain synergy. But there is a totally different angle to this Calavo deal that seems even more transformative for their valuation multiple.
Prepared foods.
Yes. The acquisition of Calavo gives Mission immediate, scaled, and profitable entry into the prepared foods market.
We're talking about manufactured consumer packaged goods, branded guacamole, and ready-to-eat salsas.
Why is transitioning from fresh produce to prepared foods so crucial for their long-term survival?
Because it completely changes their gross margin profile and fundamentally alters the waste equation of their business.
Okay, explain that waste equation.
In the fresh produce distribution business, you're beholden to an incredibly rigid grading system. You have premium grade A avocados that look absolutely perfect, flawless skin, perfect shape, which are destined for the premium grocery store display.
Right, the ones you see in the pyramid stack.
Exactly. And then you have grade B or grade C avocados. These are perfectly good, delicious, ripe avocados on the inside, but maybe they have a sun blemish on the skin or they're slightly lopsided.
Historically, those lower-grade avocados fetch a significantly lower price on the wholesale market, dragging down Mission's overall margin.
But if you own a massive industrial guacamole manufacturing facility,
The end consumer buying a tub of guacamole doesn't care what the skin of the avocado looked like before it was mashed up.
exactly. Mission can now take those lower grade, lower margin avocados that they were previously selling at a discount, run them through Calavo's prepared foods division, and turn them into a high margin, value added consumer packaged good.
Let's think about the mechanics of that. You take the ugly fruit, you mechanically skin it and pit it. You mash it. You use high-pressure processing HPP technology, which uses extreme water pressure instead of heat, to kill bacteria without ruining the fresh taste.
You vacuum seal it in a branded plastic tub.
And you have just taken a highly perishable piece of fresh fruit with a 5-day shelf life and transformed it into a branded consumer product with a 45-day shelf life.
It's the ultimate hedge against commodity price swings.
It really is.
It stabilizes their cash flow because the retail price of a tub of branded guacamole does not fluctuate wildly week to week based on the spot price of Mexican avocados. It's sticky pricing.
The strategic logic is incredibly sound. I completely see the vision of creating this stabilized, multi-commodity logistics and manufacturing behemoth.
It looks great on paper.
It does. But let me put my skeptical institutional investor hat back on. You are asking me, the shareholder, to underwrite massive integration risk.
It's a huge integration risk.
Merging two global agricultural supply chains is notoriously difficult and messy. You have competing IT and ERP systems that refuse to talk to each other. You have redundant middle management fighting for survival, which ruins corporate culture.
You have trucking routes that need to be completely redrawn without disrupting deliveries to Walmart or Kroger.
Exactly. And on top of that operational headache, you are asking me to underwrite massive leverage risk. Mission is taking on significant debt to fund this $490 million cash and stock deal.
And you're asking me to swallow all of this risk at the exact moment that your core EBITDA is dipping in Q2 because your California facilities are sitting idle.
Which brings us full circle to why the stock dropped 8% on triple the normal volume.
The market is weighing the long-term strategic brilliance of the prepared foods pivot against the severe near-term execution burden.
And right now, the execution burden looks incredibly heavy.
But management did drop a major, carefully worded hint during the Q&A portion of the earnings call that seems specifically designed to soothe that exact institutional anxiety.
Oh, about the capital allocation philosophy.
Yes, it represented a major shift. Historically, Mission Produce has prioritized reinvesting almost all of their free cash flow back into the business for physical growth. Planting more trees in Peru, building larger pack houses in Texas, expanding into Europe, and paying down existing facility debt.
But on this call, management explicitly stated that returning capital directly to shareholders is rapidly rising on their priority list post-close.
They believe they can digest the Calavo acquisition, execute the integration, and delever the combined balance sheet back to normal debt levels within 2 years.
And they stated that while they are deleveraging, they are simultaneously exploring ways to return cash to shareholders. And they're going to lay out this comprehensive new capital allocation strategy at a post-close investor day this fall.
This feels like a direct, desperate plea to institutional investors.
Please hold the stock through this messy, volatile transition period, and we will reward your patience with stock buybacks or a newly initiated dividend on the other side.
It's the evolution of a corporate narrative. They're trying to change how the market perceives them. And it ties perfectly into the broader macro context and the massive leadership handoff that is happening at the company right now.
Let's zoom out and look at that broader narrative arc. Because the timing of this entire strategic pivot is absolutely not a coincidence. Next month, in April 2026, the founder of Mission Produce, Steve Barnard, is officially stepping down as CEO after more than 40 years at the helm.
He's transitioning to the role of executive chairman.
And John Pawlowski is taking over as the new chief executive officer.
It is the classic corporate life cycle transition from a visionary, founder-led category expansion story into a mature, mathematically driven institutional platform.
Steve Barnard literally built this industry from the dirt up.
Over 40 years, he took the avocado from a niche, seasonal California crop to a ubiquitous, year-round global dietary staple. He built the physical cold chain infrastructure that made it possible. He was the builder.
And now John Pawlowski is being brought in to be the optimizer.
Exactly. Pawlowski's mandate from the board is fundamentally different than Barnard's. Pawlowski isn't just trying to figure out how to grow more avocados in new climates.
Right, that era is over.
He's tasked with compounding capital. He's leading the incredibly complex Calavo integration. He's shifting the corporate focus toward ruthless portfolio management, maximizing free cash flow generation from the existing assets, and implementing those shareholder returns.
The era of pure, unbridled volume growth at Mission Produce is officially evolving into an era of operational efficiency and capital allocation.
And Pawlowski has some massive structural macro tailwinds at his back to help him execute this transition.
Oh, the underlying long-term demand drivers for avocados are just staggering. Management highlighted on the call that household avocado penetration in the United States has hit 72%.
72%.
Per capita consumption of avocados has nearly tripled over the past 20 years. It is no longer just a trend, it's a permanent dietary fixture.
And you have new accelerating catalysts that are going to push that demand curve even higher.
The GLP-1 drugs.
Yes. The widespread adoption of GLP-1 weight loss drugs like Ozempic and Wegovy is driving a massive structural shift in consumer grocery shopping habits.
Right. People on these medications are abandoning the center aisles of the grocery store.
They're eating significantly less highly processed, high-sugar junk food, and they're moving to the perimeter of the store, shifting toward nutrient-dense, high-satiety whole foods.
And the avocado is perfectly positioned to capture that shifting caloric spend.
Furthermore, the recent official inclusion of avocados in the USDA dietary guidelines essentially codifies the fruit as a government-recommended health staple, not just a luxury garnish for a taco.
So the long-term demand curve is incredibly robust, regardless of short-term harvest timing.
Exactly.
So let's distill this down to the bottom line for the listener. You are staring at a stock currently trading at $12.15, down over 15% in the last month alone. If the new CEO, John Pawlowski, can cleanly integrate Calavo without breaking the supply chain, if he can actually realize those $25 million in cost synergies, and if he can manage the heavy debt load while navigating the Q2 margin compression caused by the idle California packhouses, then this current $12 price tag is a massive, table-pounding transition discount.
It's a generational entry point into a global food logistics monopoly.
And it is a massive boat. If the IT systems clash during the integration, if the trucking synergies don't materialize as promised, and if the Peruvian blueberry capex cycle continues to drag on profitability while the interest payments on the Calavo debt come due,
then it's a classic value trap.
It's a cautionary tale of a company that got too big, too fast, tried to swallow a rival it couldn't digest, and completely lost its operational discipline.
It all hinges entirely on Pawlowski's execution over the next 18 months.
Which brings us to my absolute favorite part of our coverage, the mandatory Talk Tickers closing segment, where we strip away the cautious, balanced analysis, and I pitch you an outrageous but plausible trade idea based on the mechanics we just uncovered.
Oh boy.
Imagine I am a hungry hedge fund analyst, and I am standing in front of my firm's investment committee trying to get $10 million of capital allocated to a massive swing.
Okay, set the stage.
I call this pitch the Produce Platform LBO REIT spinoff play. And before I go one sentence further, I must state the absolute obvious. This is not financial advice.
Not financial advice, people.
This is a purely theoretical exercise designed to test the extreme boundaries of corporate structuring based on the facts we just discussed. Do not trade on this.
I am bracing myself. Let's hear the financial engineering pitch.
Here is the thesis.
Yeah.
You go aggressively long on AVO right now at this $12.15 transition discount. But you don't just buy the common equity, you buy Leak's long-term equity anticipation securities, which are basically long-dated call options expiring in late 2027.
Okay.
Because the market is fundamentally mispricing John Pawlowski's ultimate end game. Pawlowski is an operational efficiency and capital allocation guy. He is not a farmer with dirt under his fingernails.
Okay, true.
Once the Calavo deal officially closes in Q3, he is going to look at the combined balance sheet and realize something glaringly obvious. Holding volatile, capital-intensive agricultural land like those struggling Peruvian blueberry farms trapped in their double-density maturation cycle exposed to unpredictable weather is severely dragging down their corporate valuation multiple.
Because Wall Street absolutely hates agricultural risk.
They hate weather risk. They refuse to assign a premium multiple to a company whose profits can be wiped out by an unseasonal frost. So within 18 months of the Calavo close, Pawlowski executes the ultimate financial engineering maneuver.
Which is?
He completely severs the vertical integration. He spins off all of Mission's international farming assets, the physical dirt, the water rights, the blueberry bushes, the mango trees, into an entirely independent agricultural REIT, a real estate investment trust.
Okay, I see the mechanics of where you're going with this. By spinning it off into a REIT, he instantly monetizes the underlying value of the land.
Exactly. The agricultural REIT IPOs on the open market, and Mission Produce uses that massive influx of cash to instantly pay down the entirety of the Calavo acquisition debt. Their promise of 2 years of painful deleveraging. Gone. The debt is wiped out in a single quarter.
Wow. Okay, but where does the multiple arbitrage come in?
Here is where the massive multiple arbitrage happens for the options you bought. What is left of the core Mission Calavo entity after they spin off the farms? It is no longer a farming company subject to weather risk. It is a pure-play, asset-light, fast-moving consumer goods distribution and prepared foods monopoly.
Right, because they just sign long-term supply contracts to buy the raw fruit from the newly independent REIT, run it through their optimized toll road pack houses, turn the ugly fruit into high-margin branded guacamole, and ship it to retailers.
And the broader stock market values an asset-light consumer packaged goods company vastly differently than it values a vertically integrated agricultural firm.
Vastly differently. Right now, Mission Produce is trading at roughly an 8 times forward earnings multiple because they are classified as commodity agriculture.
Exactly. But an FMCG prepared foods distributor with branded guacamole and recurring supermarket revenue, that trades at a 15 to 18 times multiple.
Yeah.
Pawlowski completely re-rates the entire company by stripping away the volatile dirt and keeping the highly profitable brands and logistics network. The leaps you bought at a $12 valuation explode in value as the market suddenly realizes they should be pricing AVO like it is Kraft Heinz instead of a struggling blueberry farm in Peru.
It's a wild, aggressive pitch.
That's plausible.
Right.
The transaction costs of carving out the Peruvian land titles, dealing with international tax laws, and establishing the legal REIT structure would be monumental. And strategically, you'd be permanently severing your vertical integration, which historically was Steve Barnard's primary competitive moat against global supply shocks.
Sure.
But from a pure multiple expansion and financial engineering standpoint, the logic holds together perfectly. It's exactly the kind of radical value unlocks a new capital-focused CEO might explore when tasked with transforming a legacy founder's business.
And that is the beauty of doing this kind of transcript coverage. You have to look past the headline numbers. You have to look for the hidden levers. You have to ask yourself what the business could structurally become in 2 years, not just what it is suffering through today.
Well said.
As always, everything discussed on this show is purely theoretical analysis and absolutely not financial advice. Do your own due diligence, read the SEC filings yourself, crunch the margin numbers, and consult a registered professional before making any investment decisions.
The transition from a founder-led, dirt-focused farm to a global, optimized FMCG logistics platform is never a smooth, straight line. There will be immense volatility over the next few quarters as these California assets sit idle, but the underlying macro demand for the product they're moving is undeniable.
Which leaves us with one final thought to consider as we wrap up. We just spent this entire deep dive analyzing how Mission Produce is trying to acquire Calavo to build a bulletproof fresh food logistics and prepared foods empire.
Right.
But consider the flip side of that GLP-1 macro trend we discussed. If Ozempic and Wegovy continue to permanently push millions of consumers away from processed snack foods and toward fresh, nutrient-dense whole foods, what happens to the massive legacy snack conglomerates.
Oh, wow.
What happens when a behemoth like PepsiCo or Kraft Heinz realizes their center aisle junk food revenues are in secular decline and they desperately need to acquire vertically integrated fresh produce supply chains to survive the next decade?
They look for targets.
Exactly. If John Pulowski successfully optimizes this massive avocado and guacamole toll road, Mission Produce might not just be the acquirer of Calavo. They might be building themselves into the ultimate multi-billion-dollar acquisition target for big food.
Fascinating thought to end on.
Thank you for joining us on this deep dive. This has been our Talk Tickers transcript breakdown, and we will catch you on the next coverage.